Imagine two massive corporate entities, once considered to be completely untouchable, suddenly entering a synchronized financial freefall. From the outside, their financial trajectories look identical. Both are burning through capital at an alarming rate, piling up massive consecutive losses quarter after quarter. In accounting terms, they share the exact same terrifying label: negative free cash flow. To a beginner, this looks like an automatic death sentence. The standard instinct is to assume a business losing cash is a broken business. That reaction is understandable. In our everyday lives, spending more than we bring in is a direct path to ruin. It triggers a natural psychological response to view any cash burn as imminent danger. But these trend lines reveal a different reality. One of these companies is strategically building a visionary empire. The other is spiraling towards total bankruptcy. How do professional investors tell them apart? What separates a productive investment from dangerous wealth destruction? Negative cash flow is a financial crossroads. To figure out which path a company is on, we have to run a structural investigation of the business model. To understand the burn, we first have to define what free cash flow represents in the physical reality of a business. It tracks the exact amount of money left over after a company pays to maintain or grow its operations. This equation shows how surplus is calculated. Take cash generated by the core business and subtract capital expenditures, spending on assets like equipment. This metric isolates actual liquid capital entering the bank account, ignoring reported earnings. Let's test this by looking at a seemingly safe example, Company B. It generates solid, positive free cash flow every single quarter. But a closer look exposes severe fragility. Company B only produces that surplus cash because management halted internal investments. Customer demand is declining, so they cut expansion spending to preserve the cash they have left. That positive cash flow is a symptom of a dying business. The raw number tells us very little without the underlying context. Now let's return to our first subject, Company A, and run a diagnostic on exactly where its cash is going. It turns out Company A is intentionally running a deficit to fund a massive physical expansion. They are pouring capital into building new factories and scalable logistics infrastructure. This chart compares borrowing costs against newly generated returns. They secure capital at a cost of 10%, but those new factories generate a 20% return on that invested capital. That spread creates value. Compare that internal reality to our second cash-burning entity, Company C. We can evaluate its health by looking at free cash flow conversion, how efficiently accounting profits become actual cash. On paper, Company C reports strong net income, but its bank account is steadily draining. The flaw is in the operations. Every dollar of that accounting profit is leaking away through rising customer acquisition costs and weak margins. Beneath the surface of rapid revenue growth, there is no foundation. Eventually, the lack of real cash generation shatters the illusion. This creates a fatal vulnerability. Because the core operations lose money, Company C's survival dictates an endless reliance on outside financing to cover daily operations. Productive cash burn builds durable physical capacity for tomorrow. Destructive cash burn merely acts as temporary life support for a broken business today. Eventually, the broader economic weather changes. Nothing separates resilient companies from fragile ones faster than a sudden tightening of global credit markets. During periods of easy money, this distinction is easy to ignore. When interest rates are low, investors willingly fund both productive infrastructure and destructive operational losses. But when liquidity dries up, the market stops rewarding growth at any cost. Rising interest rates trigger a financial reckoning. Borrowing outside capital suddenly becomes prohibitively expensive. This is where Company A secures its survival. Because it already built high-margin infrastructure, it can pause expansion and use the cash generated by its existing factories to self-fund. Company C collapses under the exact same conditions. Without access to cheap external capital to cover its daily losses, it rapidly descends into extreme debt stress. This scale shows why investors tolerate a high valuation multiple for Company A. The durable returns justify the price. Meanwhile, the market rejects the seemingly cheap valuation of Company C because the debt stress makes it uninvestable. Hostile financial environments strip away the illusion of endless expansion. They compel markets to exclusively reward companies capable of self-sustaining survival. Free cash flow measures a company's raw economic flexibility. It reveals how much room a business actually has to maneuver. Sophisticated investors refuse to base their thesis solely on the binary state of cash flow being positive or negative. Instead, they ask a deeper question. Is this company investing cash today to create a stronger cash-generating business tomorrow, or is it merely burning cash to delay financial reality? The goal of corporate analysis isn't simply avoiding losses. It is identifying durable wealth creation purposely hidden within temporary financial burn.